Welcome back, traders and investors. We have JC Parets on the line, founder and president, Eagle Bay Capital, also of All Star Charts. JC, how you doing today?
I'm doing well. How are you?
We're doing good. Just to start out here, we were giving you some props yesterday, kind of talking about the energy sector, and you kind of were looking at that show continued strength. It kind of has. I see ExxonMobil fell off a little bit yesterday. You still have the bullish thesis on the energy stocks.
Yeah, I mean, I like energy, but in particular, I like energy on a relative basis. I mean, that's really, I think, what the theme is because, overall, I just don't like the stock market. So if the market gets clobbered, there's only so much strength here. And sure, they'll hold up on a relative basis, but they're just going to get hit with the rest of them, too. They'll just won't get hit as hard. So I think that that's probably the bigger key.
What's making you so bearish?
How much time you got? Um, I mean, we can talk about so many different things. I mean, I don't even know where to start. What's making me bearish? Well, we came into the year, um, with a thought process of the risk versus reward in the stock market was really in the favor of the bears. The little bit of potential gain we could see here is really not worth the risk from a lot of different levels. First of all, the bearish sentiment in the bond market coming into the beginning of the year, you couldn't find a single bond bull out there. People thought I was crazy because I thought interest rates were going lower. Now, obviously, as interest rates have gotten slammed and bonds are through the roof, now people are like, oh, well, maybe interest rates can go lower. So now we'll probably see a little bit of a bounce in interest rates and maybe a little bit of a bond sell-off. So as money goes into the bond market, I expected money to come come out of the stock market. I'm actually surprised that 5 months through the year, the stock market is actually flat. So I would say structurally that's probably a good thing, but I think they're really just delaying the inevitable. Another problem that I see is money going into high yield at a faster rate than it's going into the treasury bond. Going into the treasury bond market at a faster rate than it's going into high yield. That typically precedes the stock market sell-off. If stocks are going higher, then you're going to want to see money going into junk at a faster rate than treasuries. We're seeing the opposite. In addition, you want to see small caps, the more speculative names outperforming the large caps, the more conservative names, and we're actually seeing the opposite, right? I mean, look at the Russell 2000 down 5% for the year, while the Dow Jones Industrial Average is flat, S&P's flat. So they're hitting the smaller names. You're also seeing that in the NASDAQ. Notice how the NASDAQ 100, the Qs, are doing much better than the composite because the NASDAQ 100 is the biggest ones, and the composite has some smaller names as well. So, all of these things, you look at volatility right now, if you look at the near term at the money vol, you're at historic lows. If you go back and do the math, 93% of the time that the implied volatility is down here. 3 months later, it was up a lot more, on average 21%. So volatility is extremely cheap. That tells us that the market is complacent. As usual, the market is probably wrong, right? Market participants. The market's never wrong, but the participants are generally, positioned in the wrong direction. And when you see that unwind, that's when you see volatility spike, and that usually coincides with a decline in stocks, as you know, right?
Yeah, I just pulled up. I just pulled up the triple Qs here, and
Mm.
boy, they are coming up to a major level. We got up to 88.46 yesterday, and then we had that pop a few days ago, 4 or 5 days ago. Got to 88.61. Also peaked our head over 88 a few times. So I
Yeah.
I, I see the major resistance there. It just looks like getting a little tired coming off that rally. See if we can
And then
get.
also but notice it compared to the composite itself. Notice how the Qs are doing better than the composite because the Qs don't have the smaller names like the composite does. Isn't that interesting?
Yeah, it is. So, okay, we're just gonna skip here. Some people in the chat have been coming up with some symbols here, and I
Sure.
wanted to get to them. Boeing here. The stock has been in quite a range, a pretty good range. Peaked his head up over 132 here. Put in a double top, it's come down. It looked like 130 looks to be excellent support here. What's your short-term and long-term outlook for Boeing?
I structurally, I mean, this thing has just been an absolute beast. I mean, we already took out the '07 highs, so it's definitely one of the stronger names in the Dow, no doubt about it, both on an absolute and relative basis. I feel like you could kind of put this in the same camp and same argument that we were making with energy a few minutes ago. Sure, on a relative basis, it'll probably hold up better than the others. But if the market gets slammed, it's going to get slammed with it. I think structurally, you could probably stay long above 122. Tactically, yeah, that 130 level is probably your stop.
Okay, and then coming up on the upside, I see two highs here: 133.83, 133.97, couple bucks away from that. So I wouldn't look for a continuation up to fill the gap. You have that gap down. That was a huge fall. Look how it goes from 144 and change. Let's see here. 144.57 under 120, and how long did that take? One, two, three, 10, 12 trading sessions, and now it's taken all this time to recover. Now it's back at the top of the range here. We'll see if it can follow through that 134 level. And another stock that was coming out of the
Well, I'll
chat
tell
room.
you this, and just real quick,
Go ahead.
I think this is just from a study point of view. I mean, this is a great example of the old escalator up, elevator down. We've seen it a million times. We're going to see it again. I mean, that's just a perfect example. And I'll say this: I mean, stocks in bull markets, don't tend to get destroyed like that so quickly. So, I'm a guy where I look at thousands of charts and thousands of charts, and I say no, 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 maybe, no, no. I'm constantly saying no. I'm very, very picky. And this one, just from a risk-reward perspective, obviously it depends on your time horizons and everything like that, and we talked about two different things. For me, I'd stay away from this one. I don't think there's really any reason to be long or short, really.
Okay, NE, that's Noble Corp here, and this thing has just been in a range for a long time. See the
Yeah.
major support at 29.50. It looks like it's not going to be out of the woods until it clears 31. JC, what's your take on NE?
Yeah, this thing's a mess. You know, I mean, again, depends on your time frame. Structurally, this thing's just a disaster. If you're looking at a weekly chart, you do have some support here in the high 20s. I mean, I would say maybe if it gets above 31, maybe you could play it from a mean reversion. But I mean, let's just use common sense for a second. We're in one of the most explosive bull markets in American history, and this thing's making multi-year lows. I mean, if you're going to be in a stock, is this the one that you want to be in? That's the way I look at it. So sure, can you get a bounce? A counter trend rally for 3 or 4 points or something like that, and you could play it with a stop below 29.5. Sure, if that's your prerogative and that's how you trade, that risk reward is okay. I mean, what are you looking at? You're looking at 70 cents to the downside, maybe 4 or 5 points to the upside. There's worse risk rewards out there, but I mean, this is one of the worst stocks out there in one of the best markets. So it doesn't really make any sense, from that perspective.
Well put there. Okay, let's move on to the momos, and Apple's had a nice move here over
Yeah.
600. We got the split coming up. What's your take on Apple?
So Apple's interesting, and I've definitely been wrong on this one. I figured it was dead money, but as soon as it gapped up after those earnings, it was definitely a breakaway gap and go. And you can't be closed-minded. You have to be open-minded. When you see something like that, the data changes. You have to change your mind with it. And this was definitely explosive. I could totally see more upside. We could see 700 or something like that. But you really only want to be long above those December highs. So, if you're going to be in this thing, you really only want to be long above 575 or so.
Okay, and just some of the other momos got destroyed. I mean, did you see all the upgrades Twitter got last week, and the thing went absolutely nowhere?
Yeah, and again, it's an upgrade from, sell side analysts that, that had this wrong for the most part. Remember again, you look back, sell side analysts, when you have consensus, they're always wrong at the worst possible time. So when you talk about these upgrades and downgrades, I mean, for me, I try to just ignore all of that stuff and just really focus on price because, that's never going to get revised, right? Everything else are just estimates. But in this case, we're talking about true facts. In terms of Twitter, I don't see a trade there. I don't see momentum improving at all. I don't know where I would put my stop. I guess you could put your stop at the all-time lows if that's what you want to do. Maybe we get a mean reversion trade back to 40 here. So if you have to be in it, which I don't see a point, you got about 2.5 points to the downside. To the upside, you got maybe 10. Is it worth the risk?
Yeah, wow.
Not for me.
No, I mean it just seems like you had that disappointing earnings season. Now you don't have a catalyst coming out for a while, so I think I'd have to agree with you on that. It is taking back half of that move from 29.51 up to that high 34.10. You've had five lower highs since hitting that 34.10 level. Kind of stuck in the middle here. I'd like to see this thing, if you are bullish and looking at the retracement of the move, holding 32. You're correct, JC, with the stop out down at
Yeah, I
29.51.
mean, to me, that's way too much risk. I mean, we all have different time frames and horizons and everything like that, and we're all different. So maybe that's enough risk for somebody else, but that's way too much risk for me.
Okay. All right. Some of the other momos are showing some life here. Let's start first with Facebook.
See what Facebook's looking like. So I like this little consolidation that we've had here over the last couple of months. I will say that that's constructive. So there's two arguments here, right? So the first argument is, okay, this could be potentially a bear pennant, if you will, and a breakdown will lead to much further downside, or this could be building a nice little base for the next leg higher, right? So those are really the two arguments. So we want to look at momentum and see what momentum's telling us. Momentum on a short-term time frame on those highs in March was putting in a bearish divergence, and on the weekly chart we also have a bearish divergence. So when I'm a weight of the evidence kind of guy, right? So when I just made the two arguments, the bull and the bear case for this particular consolidation, momentum is hinting that the resolution will be to the downside. Now, that we would just be guessing here and anticipating a break before it even happens. So I would say if you're going to be long, you probably want to get long above that 64 resistance, wait for that breakout, and if you want to get short, wait for a break below that 54.75, 55 level, and just wait for the resolution. We have a very similar situation in gold, by the way. This consolidation over the last couple of months, very, very similar to Facebook, in fact. And again, by anticipating what direction it's going to break, we're just guessing. So I would just prefer to wait for the resolution on both gold and Facebook. I think
With
that's a smart thing to do.
Yeah, on Facebook here, it's kind of interesting because you had the low of the move and filled the gap or almost filled the gap, pretty darn close, and then you had to run up a pullback, and then you basically had a triple bottom on top of a triple bottom. You had the 56.50 area, another bump up here, then you came down to the 57.50 area. So I don't know. I think on this one, I wouldn't wait for that low of the move. If it took out those three lows at the 57.50 area, I'd expect it to go back down. Coming back on the upside, boy, it hit that high, it hit that 64 area right in earnings, but yeah, you see just a couple tops coming down above 62. So kind of a tight, really it's been in a training range here. You can also, if you just want to be real technical, you could get a nice little triangle here, and it's really
Yeah.
starting to trade right in the middle of it. So could get a nice breakout in it. Okay, moving
So that's
on.
exactly right. That's exactly what I'm referring to, that particular triangle. And we're right in the middle of it. So to guess where it's going to resolve itself, to me, it's just silly. Just wait.
Okay, just finish up here with a couple of other of the momos. Tesla trying to climb back into the 200s here. Got hit off the earnings. Got a nice stair step rally going here, trying to fill the gap here. What's your take on Tesla Motors?
Again, just like Facebook, you have those bearish divergences in momentum at the recent highs from March. Facebook has the same thing. So, if you have to be long this name, you probably only want to stay long above 176.75-ish, right, which were those lows from earlier this month. So if you're going to be in it, you could use that as a stop. And then, maybe for a confirmation of further upside, you can draw a nice clean downtrend line from the February highs, February 26th or something like that. You could draw a trend line right there. We break out above that, we could see, maybe a retest of those highs. So, if you got to be in it, use that as a stop. And if you want to add to the position, maybe you could use the breakout above that downtrend line.
Okay.
That's what I think makes the most sense to me.
Okay, all right, and now just to finish up with the momos here, Netflix. That stock has had a little bit of a rally too. What's your take on Netflix?
Netflix is interesting. You know why? Because those 2011 highs, we came back and we retested that former resistance successfully. So that's very, very interesting. And you have bullish momentum divergences at the recent lows from late April. So the long-term correlation with the S&P is pretty high in Netflix over the last few years, but short-term we're finding very low correlation. I think it's got I think it maybe has a shot. Again, I think it really just boils down to, if the market can hang in here and not get clobbered, I think this has the potential to maybe retest those highs. But man, if this market rolls over and they start selling it, this thing's going to get crushed. You know that these Momo names are the first ones they're going to go after. So that's kind of really what I'm worried about in the stock market overall, particularly in U.S. stocks. If I'm going to be in the stock market, I'd probably rather be in other countries, really.
Okay, and just looking at this Netflix here, it hit 367.22 yesterday, and I was hoping it was going to get a little higher up to the April 23rd high, 367.50. So got a good resistance point in that Netflix at the 367.50 area. Okay, JC, just going back to the overall market here. You said if we're gonna get hit. I mean, just doesn't seem like there's a driver to take us higher or lower. What do you think is going to be the catalyst to take us through the well, I'm looking at the 1860 level now as the major support. What you think is going to be something out of the Russia, Ukraine, stock specific, interest rates, Janet Yellen? What's going to be the driver to get us going to the downside?
Um, you know, I honestly think that we're already in a recession. Not in a recession, in a correction. Recession. I don't really care about the economy. A correction, because it's almost like, and somebody was using the phrase stealth correction, where you have the small caps getting clobbered. You have some of these momentum names getting absolutely destroyed. Some of our favorite names that we've been talking about for the last couple of years or year, down 40, 50%. You know which ones we're talking about. So it's almost like you can't just look at the Dow Jones Industrial Average. You can't just look at the S&P 500. A lot of these names are getting hit, and it's almost like, I think it was Ralph Acampora who said it. It's like somebody's like keeps taking money out of your back pocket when you're not looking, is really what it's like. So although the S&P is flat for the year, the Dow is flat for the year. Russell's down 5%, and I think we're really just delaying the inevitable in terms of the large caps. So when you're asking me what's the catalyst, I'm not a why guy. Who cares why? We don't get paid to know why. Market has never paid a single person in history to know why. You get paid to know what, you get paid to know when, and you get paid to know how long. So I think we're already in a correction. I think that what we're seeing is money flowing into value and out of growth for the first time since 2008. And I think that big reversion to the mean will continue as money flows on a relative basis into value and out of growth. We're also seeing money flowing into large caps, out of small caps. We're seeing money flowing into treasury bonds, out of high yield. All of these things are already happening. You have financials, which are the most important sector in the market, is the worst performing sector since last summer. The worst performers. So you have Bank of America already breaking down. You have Citigroup and Goldman Sachs, two very important stocks. They're at major, major support. So Citigroup breaks 46. Goldman Sachs takes out 154 to the downside. These financials are in a lot of trouble, and they're already underperforming. So these are early cycle sectors. So when you're seeing these early cycle sectors, discretionaries, financials, underperforming the overall market, and then you have cycles that tend to do sectors that tend to do well at the end of cycles, like energy and utilities being the best performers these days. Everything, sector rotation, money flow, is all telling us that the correction is really imminent. So that's why I think from a risk-reward perspective, is the stock market where we want to be here. I've been saying no all year, and I don't see any evidence that suggests me changing that thesis. I would much rather be in commodities. I would much rather be in bonds. And if I'm going to be in the stock market, why would I be in the U.S.? There's so many better countries out there. I mean, and it's not, we're in a global marketplace. I mean, look at Ireland and New Zealand and Norway and Egypt, and these are stock markets that are on fire that have very little correlation with the S&P 500. So if you're going to be in stocks, I don't think the U.S. is where you want to be.
Okay, we've had JC Parets on, founder and president, Eagle Bay Capital. Also, All-Star charts. JC, thanks for your outlook on the market. Have a great trading day, and we'll speak to you soon.
Thank you so much. I'll see you soon, guys.